Everyone on Zoom see the screen?
Yes.
Yes.
All right.
Yes.
Okay, so chapter 2, we're going to get into financial statements and how do we get all of the numbers onto the financial statement? Where do they come from? So we're going to talk a little bit about that. So when we're in business, there's many different types of businesses that are going to have lots of different types of transactions. So what would be examples of transactions in a business? Any examples? Sales transactions. Purchasing. Taxes, we'll have to pay taxes. Rents. Payroll. So all of these things that you're naming are source documents. If you look at the notes that I put on Moodle, it kind of outlines everything that's in the chapter. It'll have all the different source documents that we just talked about. So we'll have different transactions that happen in the course of business. And some of those you already named. So we have bills that we're going to be paying for either material or people that we use. It could be utilities in the facility that we're renting. We have rent bills. We'll have sales. We're going to either be selling ourselves or services or products. And then we'll have checks. We'll have to go through the process of cutting checks. And when we cut checks, we're going to be entering those into the system. And then we'll be sending those payments out. So we have to find a way to keep track of all these transactions that are coming in. We also have purchase orders. Sometimes we're set up to be able to buy with a purchase order. And we'll issue those purchase orders and they'll be linked to product and product prices. You have to check those. We have payroll transactions. We're going to be reconciling our bank statements. So the first thing that happens is we have some sort of transaction that happens in business. When we have a transaction, we have to figure out a way to get that into the computer. So old days, everything was done on paper, brought over to the accounts. Now we'll walk through the process of doing it manually. But as you know, there's a lot of different software out there that a lot of what we're going to learn how to do in the classroom is now done through the computer software. So we'll talk about that as we're going through things. So we'll have these source documents. They're called transactions. We're going to analyze those documents. We're going to analyze those transactions. And whenever you're looking at these transactions, remember we talked a little bit about double entry. There's always going to be two sides because we have that equation that we have to keep in balance. So we're always going to have two sides to every transaction that we do. We record the transaction. That's just making sure we enter that journal entry. That's how we're going to do it in the class. We're entering journals and it'll have at least two sides. And we're going to post the journal, which is bring them in over to the accounts. And we're going to keep a record of these transactions that are happening in each one of the accounts. And once we have that, then we can first you'll bring it over to a trial balance, look at it, make sure everything's in balance. And then you get to your financial statements. So does that make sense as a whole before we move on? It's really important to understand what's happening. We have transactions that we're going to have to analyze, to put those into the record, post those, and they're going to go over to the accounts. We're going to reconcile the trial balance, and then we're going to push those over into financial statements. That's the whole process in a nutshell. So
it makes sense what you're saying,
Mhm.
but like honestly, the first, I mean, it's just like it's Mandarin and Chinese to me when I'm like
trying to just read it
yeah,
and figure it out. So
Yeah.
hopefully the lectures will help put pieces together for you.
yeah.
And then ask questions as we go if it's confusing. Some things will be more confusing than others. Some are real easy. But we'll go through it and we'll do examples. We'll talk about the homeworks. If you've looked at the homeworks and you have questions when you come to class, we'll go through it. So we have accounts, and the way that most companies set up their accounts are either with a description only or a number in a description. So it's very common to see the number and then a description of what that account is. Some smaller companies maybe will not have account numbers, but if you look at the chart of accounts or you look at accounts, a lot of times it'll be consistent from business to business. So if you see something that starts with a 1, a lot of time that's an indicator that it's an asset. If you see something that starts with a 2, it could be that all those 2s are liabilities. So you understand what I'm saying? If it's a 3, it could be an equity account. If it's a 5, it's an expense. If it's a 4, if it starts with a 4, it could be sales. So there's groupings, and a lot of times that's consistent. It's not set in stone. There's no criteria that needs to be followed. It's by the business, but a lot of times that's what you'll see. That's how it'll be set up. So in those accounts, we're going to be increasing and decreasing. So depending on what the transaction is that we're recording, it's either going to increase that account or it's going to decrease that account. And then we're going to have something on the other side that's going to be increasing and decreasing.
Which is what gets me, is because like,
Right, because you're going to be hitting at least 2 accounts in every transaction. So depending on what it is, it could be multiple. So we'll walk through that. So we'll have asset liabilities and equity. In the equity section is going to be all your revenue and your expenses. Your dividends will be in that equity section. We'll go through all that at the end. We'll walk through an example, and in the homework, there'll be an example of setting all those financial statements up and looking at the accounts and what the amounts are and where they go. So that's what we're going to be doing in chapter 2. So some terms. So we have something called the general ledger. If I said I wanted a general ledger detail of a particular account, I would go to my software, and there's reports set up in the general ledger system. And I can say, okay, I want to look and see what do I have in expenses that are hitting my building supplies. So at my company, we keep track of everything through our service system that's being billed to tenants in the account called building supplies. So it's going to be some kind of building service or supply that's going to happen that's going to run through that account. So when I'm looking at that account, I want a general ledger detail. So I'm running a period of time, and all I'm getting is that one account. It's giving me all the information that's in that account. It's going to give me a balance. So if I ran a general ledger for all the accounts, obviously there would just be an order of the account, however you decide to organize it, and it would list everything there for you. I think I have an example here. So this is an example of a general ledger. So if I ran a report, you'll notice that it has the account, it has the account number. Sometimes you'll get an account description as well. And it shows you all the transactions. So for this account ID here, I have all these transactions that are happening. It gives me some information that goes along with it. And then it gives me some amounts. It's telling me, okay, I had a debit here, I have a credit here. This is my running balance over here. So this is typically what it would look like if you want to report in an accounting software and say, I want a general ledger detail or a general ledger balance. It would give you all this information. So you can get the detail in it or not. Okay, so we're clear what a general ledger is, right? General ledger is just a listing of all the accounts and the balances that are in there. Then we have the chart of accounts. So chart of accounts, what that means is, here's a list of all my accounts that I have that I can use in this business. This is what I have that I can use in my transactions when I'm going to do my entries, when I post and record those entries. These are the accounts that I have available. So you'll have a process of setting new accounts up, editing those accounts, but you'll have something called a chart of accounts, and it has the number, the description, and a lot of times it doesn't give you a balance. It's just a listing. It's just telling you, here's the accounts that you have that are available to you. So when you're setting up these accounts in an accounting software, it's going to ask you some questions. What kind of account is this? If it's something to do with costs, if you do cost accounting, it'll have in there your cost accounts. It'll ask what piece of inventory does this get tied to, because you'll have inventory and you'll have costs associated with it. And so then you'll have a revenue account associated with that same piece of equipment as well. So when you're setting up the account, you'll have all these questions. So you'll see that it tells me cash is number 1001. What type of account is cash? It's an asset. Where does it show up? What financial statement is that going to be on? It's going to be on the balance sheet. So as you start looking at these different statements, you should know what type of accounts are going to show up on those statements. Okay. So this is an example listing of a chart of accounts. Okay, double entry. So let's just talk about that a little bit. And I wanted to give you a tool that you can use, helping you when you're trying to figure out what has happened in the account and what is my ending balance. So double entry means we have at least 2 accounts that'll be affected by that transaction. So for example, let's say that I buy something, maybe I buy some office supplies. So my office supplies are considered an asset, something that's going to benefit me in the future. So that's an asset. And cash is also an asset. So maybe I use cash to buy the supplies. So I have 2 accounts that I need to do a journal entry in. I have to obviously decrease my cash. So if an asset has a normal, what balance, debit or credit? Do you remember from last week? This is like very distracting, that noise. The debit. Assets have a normal debit balance. So normally we have a debit for cash. So if I need to decrease cash, I'm gonna do the opposite, I'm a credit. So that's one account that's affected by it. And then I'm getting some office supplies in that I'm gonna be able to use in the future. That's a benefit for me. So I'm gonna set that up as an asset. So if it's got a normal debit balance, when I have that asset, I'm gonna debit the office supplies. So if we wanted to follow a bunch of transactions and we wanted to look at what is the balance and what, maybe I have a bunch of transactions and I want to know what's happening in cash. Just want to know where my balance is at the end of all these transactions. I have something that I can use called a T account. So the T account is set up just like this. It's a T. On the left is a debit, on the right is a credit. Doesn't matter what kind of account it is, it's always set up the exact same way. This can be a little tool to help you figure out what is the ending balance at the end of all these transactions. Okay, so let's just do one. I have a T account. This is my debit side. This is my credit side. Let's say I want to follow cash. Maybe it's account 101. Okay, I'm going to tell you that my beginning balance is $500. So I know that the normal balance in cash should be a debit because it's an asset carrying a debit balance, right? So I have $500 in my beginning balance. I automatically know because I know that account. I know that it's going to have a debit balance unless I tell you otherwise that it's negative in the account that you wouldn't have it. You wouldn't have a debit. But if it just says my beginning balance is $500, I know I'm putting 500 on the debit side. So then I bought those supplies. When I buy the supplies with cash, I'm reducing cash. So I have to credit cash. Let's say it was $100 for those materials. So I don't need to know what the other side is when I'm doing the T account. In this example, if I just want cash. If I wanted to follow supplies, well, then I would do another T account for supplies. I'm buying supplies for $100. So then now I have 2 things happening. Okay, let's say I buy supplies on credit, meaning that I haven't paid for them yet. So does anybody remember, if you haven't paid for it yet, what kind of account I have? A payable. I'm liable to pay in the future. It's called an accounts payable. I have an account that's payable in the future. So it's a liability. I'm liable to pay that in the future. So let's say I have accounts payable and I have, let's say 200 of supplies. I'm increasing accounts payable by $200. It's a liability account, so it's going to be a credit. Credit means I'm increasing a liability account. Okay, so I'm getting supplies. If I get an asset in, to the debit or credit? Debit, 200. So you see what I'm doing? I'm just kind of walking through the transaction. If I only wanted to focus on cash and know what that balance was, then I would just set my T account for cash and I would look for all the transactions that are that involve cash. And I would just track that one. Maybe I'm wanting to do an example where I'm doing multiple T accounts for all the accounts. You will have a homework like that, where you have to walk through different transactions and you'll have your T account set up for all your accounts. And this will be just where you're placing them, and they're usually lettered or numbered. So if I have A tells me I have $500 cash as my beginning balance, you're not going to have another side, it's just giving me some information. B says I'm buying these supplies for $100. Well, then B would be this transaction and this transaction. I'm buying supplies of 200 on credit, C. So C, it would be my number here. So the homework should do something similar to that. This is a good little tool. So even if I'm not asking you to do a T account on test, I'm just looking for an account balance, you can use this tool to help. So that's why I set it up in the homework. So that way you can do that on the side and help you figure out what the balance is. Okay, so do we understand what a T account is? Those can be useful. So I made a note on the PowerPoint that I have on Moodle. There's slide number 17 has an image of, it tells assets equal liabilities plus owner's equity. And it tells you, okay, a debit and a credit, when it's increasing, when it's decreasing. That could be helpful when you're studying to look at it, to know, okay, here's an asset account. If I do a debit, it's an increase. If I do a credit, it's a decrease. The liability, and I do a debit, it's a decrease. If I do a credit, it's an increase. It might be a good little tool just to look at that picture and memorize what's happening if you really understand the transactions. That can help you when you're doing your entries. So number 17. Okay, a trial balance. So I don't know if I have a picture of a trial balance. No, I didn't bring one in. So a trial balance, let me explain what that is. So we do a bunch of transactions. We started business with a bunch of transactions that we put into the software. So we went through a bunch of different purchases, sales. Now I want to look and see what are the account balances in each one of those accounts so I can prepare my financial statement. You can run something called a trial balance. And when you're using an accounting software, obviously the computer's doing all the posting and doing journal entries for you. So you just put the transactions in. Let's say I have a payable invoice. So I bought those supplies on credit for $200. And I got a bill from Best Buy for $200. So when I enter that into the computer, I'm not actually doing a journal entry. I'm entering it into a module that's been set up to accept accounts payable. Usually there's a tab. Has anybody used QuickBooks? Okay, one person? Okay. You use it? Years ago, not recently. Okay, well, okay, so you know how at the top there's a menu, and it'll have like maybe general ledger stuff, it'll have accounts payable, accounts receivable, could have inventory, but you could have all these different buttons at the top. Maybe you have financial reports. So in a computer software, you would just go to the payables module and enter bill. So that's all I'm doing. I'm going payables, enter bill. What the computer is going to look for is you to put in the vendor name, the date that you bought it, maybe a purchase order number, what the amount was that you were spending. Maybe you have inventory and you're selecting an inventory item. How many of those items did you purchase? How much are they individually? Was there any freight on that invoice? And you're keying all these things in, and then you hit enter. So that's all you're doing if you're entering payables at a job. You sit there and you're entering that information into the computer. You're not actually doing the journal entry. In the class, we're going to do the journal entry so you know what the computer's doing. What the computer's doing is it's logging all of that into a register for accounts payable. And when we get to payables, I'll show you an example of a listing of an accounts open payable report that shows you all the different vendors and the amounts that you owe. So what's happening is it's going to accounts payable as a credit, and then it's going to either an expense. So if I put in a rent bill, it's going to rent expense. I've maybe coded it to that account. Maybe you have a software that memorizes the account numbers that you use last. So every time I go to enter into the file organization that I'm paying rent, It's always going to go to that same rent and expense account number on that invoice. Maybe the system doesn't do that, and every time you get a bill, you got to look up the account numbers. So a lot of times it's memorized on the last transaction. QuickBooks even does that. So you have two accounts that were affecting that accounting equation. So even though you're just entering a bill, doesn't seem like really anything's happening, but what is happening is you're going to have a debit to either an expense account or an inventory account for supplies. If you bought equipment, it could be an equipment account. That's your debit. So either an expense or cost, or it's going to be an asset, more than likely. Then on the other side is the credit for your accounts payable. So you're entering a bill, you do no journal entry, but you have double entry happening in the software. Does that make sense? Do you have any questions? Okay.
I'm not monitoring upstairs.
You can if you want. They're on the second floor, you know, where the when you come up the stairs to the left, they have those windows with the computer lab. Yeah, see if they know how to turn it off. That would be great. Thank you. So anyway, once you do that a bunch of times and you have your entries, now you're going to go to your reports and you're going to say, I want to get a trial balance. Trial balance is going to have a listing of all your accounts and it'll have the balances in there. So a lot of times what I'll do at the year end is I want to make sure I have a final copy of that trial balance. What was the amount in all of those accounts? And I'm looking at it, and 99% of the time, because you're using a computer, it's going to be in balance. But in class, you are manually going to have to take all those accounts that you just went through on your transactions and bring them over and know from your T accounts, what's the balance in each one of these accounts? And it might be out of balance. You want to make sure credits and your debits equal. Okay, so all your debits will be on the left, all your credits will be on the right. Make sure they equal. So you're going to have all your transactions, maybe using a T account to find what the account balance is going to be. Those balances are going to get brought into all the accounts that we just used. Okay, if they don't balance, so a lot of things, you know, they have a list of things you can do on the notes. One thing is just go back and make sure your math is correct. Make sure everything's added up on both sides correctly. Make sure you go back to the transactions. Look and see if you picked up those amounts correctly and brought them in. Make sure those amounts, you didn't transpose a number. Sometimes that happens because that can throw it off. Look at it again and make sure, did I do both sides of the entry? Did I, you know, make sure it went here and it went here? Because sometimes if we forget to do the other side, that can throw it out of balance. So you just want to walk back through your transactions. So if you look in the notes, they'll have some little information on there that will be helpful. But when you're going through the trial balance, if you're out of balance, just to walk through those steps to try to help find the error. Okay, journal entries. So because we're in the classroom and we don't have the computer software, which they used to have a lab for the accounting students that you would have to use QuickBooks and set up a company and you would have to do all the transactions and enter journal entries. I'm not sure if they still do that. Do y'all know? No? So I find that it's very useful because once you know one software, it's helpful when you go in and you start working. So this is an example of a journal entry. So a journal entry typically will have the date. A lot of times it'll have a transaction number, and those transaction numbers a lot of times are just system generated. They automatically will just pop up the next one. They will never have two of the same, which is good because you don't want to have two of the same. You want it to be independent of each other. So you also have your account title and description. So on here, it just says cash. Maybe if you're looking at a software that also has account numbers, it would have the number in the description. And for this transaction, we have someone that is investing in the company and they give us $30,000. So maybe you want to start your own business. So maybe you're starting your own business and you're going to take $30,000 of your own money and you will put that into the business. You set up a checking account, you deposit that money, now you got to record it on the books. Well, we have cash coming in, which is a debit, so we make sure that that goes first. Debits will always go first on the journal entry. So we have cash 30,000 as a debit. The other side of that is you're trading that cash for common stock. So now I have a credit for common stock, and it's just the owner's claim on what they've invested into the business. So now we have a credit for common stock for 30,000. So that's if we receive money from an investor. On December 2nd, we buy supplies. So I'm spending $2,500 on supplies and I'm paying cash. So now I have supplies, $2,500 as a debit, that's my asset. And my cash is going out, it's another asset, but it's a decrease. So I'm gonna be crediting cash $2,500. So if I wanted to know where's my cash balance, obviously you just take the 30,000 plus the 25, and then I have my ending balance. Okay, so this is the structure of a journal entry. So if I give you anything, I'll probably have the line set up, and would want you to write it in this format. It'll be debit is going to have the account number with the amount, debit on the left, and then there'll be a little indentation, and you'll have the credit with the credit amount in the credit column, which is going to be on the left. The two should balance at the end. So remember, we are affecting the equation. We want to make sure everything's in balance. So we're always making sure everything's in balance because we're doing two sides to the entries.
What's the PR?
So the PR would be like if you had some sort of transaction number there or whatever. I don't know what it stands for in the book, but a lot of times it'll have like a record number. It just doesn't show you the record number here. But if you're in a computer and you run, your journal entry or your edit list from your journal entry, you'll have that number on there. Okay, so the trial balance leads into the financial statements. So this is an example of what the trial balance and the financial statements will look like. So the first one is the trial balance. So remember, I told you that it's just a list of the accounts, debits on the left, credits on the right, with the account balances. So if you look to see, all of these different transactions that were done are going to end up with these balances here. At the bottom, where the total is, both debits and credits equal. So everything's in balance. So that's what a trial balance looks like. And then we have an income statement. So the income statement, we talked a little bit last week. We have income and we have expenses. So all of our sales or any kind of revenue is going to be our income. And then anything that we have that's going to offset that, which is money that we have to spend out. It could be taxes, it could be supplies, it could be just regular operating expenses. All of those expenses are going to get deducted from the revenue. In the end, the net is going to be the net income. So this is an income statement. So the income statement is going to have your revenue and your expenses. Should be easy enough, right? Income statements, got your income, then you offset the income. So the title is for month ended. And the reason why is because we want to capture it for a period of time. We want to look and see, okay, so now it's June. I want to see through June to see how I did. Maybe I only want to see through March. So I'm going to run it through March, and it'll say for month ended March. So that way the user of the financial statement knows the period. Okay. So when we set it up, revenues is kind of the title of your revenue. So you'll have that on the side, and then a little indentation is how you'll have to set it up on the homework for the tables. You'll have a little indentation for your revenue accounts to capture those, and then your amounts. Then expenses, again, it's going to have a little title offset, and then it's going to be a little indentation for all your expense accounts. So I don't think that on the homework tables, it's going to have those titles. You'll have to know to put those titles in. Okay. I think it's a wider bar and you have a drop down menu. So I don't know if it's just saying revenue.
and you have to pick every part of it.
You went through it?
Yeah.
Yeah, so I think you're gonna have to put the titles in. So you're gonna have to know the structure of how it's set up, the formatting. So in the end, you have your net income. Net income is gonna be used for the next statement. You have to figure that one out first, okay? So always start with your income statement. Now we have a statement of retained earnings. So every year, retained earnings, what that is it kind of gets the leftover. So if you made money, everything will roll into that retained earnings account. If you lost money, it's gonna deduct from the retained earnings account. First year, obviously, is 0. So let's say, in this example, the retained earnings at December 1 is 0. This is our first year in business. So we don't have anything, or maybe we used everything and had 0 last year. Let's hope not. Let's hope this is the first year. So we're actually going to make money. So the next step is to add the income. Where's the income coming from? The net income is coming from the income statement. You just figured out what your net income was on your income statement. So that balance is going to get pulled in. And the reason why is because every period, let's say it's a calendar year, is your period of time that you're going to be, doing your sales, collecting all your, information and put it into the system with your transactions. You're going to have expenses that are going out. You'll have a net income at the year end. Well, when I start the new year, I want all those accounts to be zeroed out so that I know now what I'm making this year. Does that make sense? So what we're doing is there's a humming. I don't know if you know how to turn it off. If you show me, I'll do it next week. Hang on one second.
When does it hum?
Periodically, just whenever. I don't know if you just heard it. I'll keep talking, maybe that. There it is. So I have the volume turned down. I hit mute, but that turns that off.
Mm-hmm.
I have a Zoom session going on too.
So this is something coming from your laptop.
No, because it's there before I put the laptop there.
I have a class on Thursday afternoons and he was using the chalkboard, not even this, and that was going on.
You need to put your mask back on. I mean, you're not using the PC.
I don't hear it now.
Mm-mm. Is that happening because the computer was off?
I don't know. That's strange.
Yeah.
But if that's the case, I'll just move the mouse every once in a while. That's an easy fix. Yeah. That might work.
You're not using this today? right?
No. Mm-mm.
Okay. Just-
No, I have the camera here on the laptop and I'm just actually sharing the screen for the video. Okay, so back to statement of retained earnings. Okay, so we have a beginning balance 0 because this is our first year, there's nothing there. I'm going to add my net income. So the net income comes from the income statement. So I'm going to put the net income, I'm going to add it to that. And then what happens is when it goes through to the new year, when you run it, when you're running your statement of retained earnings, you'll have that balance roll into your income, balance sheet for the retained earnings. Now it'll have a balance there after the first year. Okay, so we got to add the net income and we need to do less the dividends. So remember, dividends are part of the equity section. It's going to be similar to an expense. It's reducing what we have in our net income because we are going to be paying out to the shareholders part of the money that we've made this year. Okay, so when we declare the dividend, we're going to send that out. So that's going to deduct from the net income. Okay, then we have the ending balance, retained earnings at December 31. That's our ending balance. That's the balance that will roll into the new year as the beginning balance. Okay, so now all the income and expense accounts are closed out, which we'll get into in a later chapter, and we start fresh for the new period. So maybe the new period is that calendar year. Okay, any questions so far? Now we go into the balance sheet. So the balance sheet's going to have basically our accounting equation. Assets equal liabilities plus equity. Okay, a lot of times left is assets, right's liability and equity. So we have assets, we list out our assets, what the balances are. We're getting that from the trial balance. Remember, we had that trial balance that told us what the balance was in those accounts from our transactions. That's where the amounts are coming from. So we're setting up our cash, furniture and equipment, having a balance there. We're going to total them up. So I know that that total should equal the liabilities and equity once I get them on there. Okay, now I have my title liabilities on the right. The only thing we had was accounts payable. Sometimes you could have notes payable. Remember I said that you could maybe owe someone something, but not cash, maybe a service. That would be unearned revenue. That's a liability. I'm liable to do that service in the future. So that could be listed there. And then we have our equity section. So we have common stock of 18. Remember we went through the example on the journal entry that was someone that gave cash and traded for the common stock, right? 30,000. So if you have a transaction like that, that's where this would go. Common stock would go here. And then retained earnings is what we just figured out on the retained earnings statement. Okay. So our retained earnings is 330. It's coming from your previous statement that you just calculated. Now I know my total liabilities and my total equity. I add them together. It should equal assets.
How though?
How does it equal?
Yeah, I mean, you know, they're just such different things. How would it equal?
It is different things, but remember when you're doing your transaction, everything has two sides, right? So you're always in balance as you're going through. And if you walk through the steps and all your accounts go into the correct statements, in the end, your balance sheet will reconcile.
I mean, because like, there just happens to be $600 worth of furniture to make it balance. I mean, that just seems so.
Well, it goes by your transactions that you're doing. So when you're putting the, let's say you're using T accounts, when you're using the amounts from the transactions and they're going into the T accounts, everything is going to be working together. So it's not like you're going to have one random account that's going to have an amount in there that doesn't make any sense. So you're going to have, everything's going to tie in because you're going to have everything working together with those transactions. So then once you have your balances of everything was done correctly and you start pulling them in, it will balance. All of your accounts that were used for income and expenses, you're basically netting them out to find a net income. So those are all getting pulled in to that net income. And then when you do your statement of retained earnings, you're using that balance from all those accounts to come up with a new balance for your new retained earnings. You have dividends now that you're pulling in, so now that account's scratched off. So now you have another balance, and that balance is going to pull in. It just happens to work out because everything else, if it's not clearing out on those income and expense accounts, it's going to be a liability or an asset, or the common stock, which is usually just one transaction in which you're going to be doing. So it should work out. It should balance. We're going to walk through it.
Okay.
I have an example set up that we'll do. Okay, and then we have the debt ratio. This is our formula for today. So the debt ratio equation is total liabilities over total assets, which this didn't have an A. Okay, so you want to know what that is. You'll have to do a couple of those on the homework. So it evaluates the level of debt risk. So you want to know how much do they owe? What's that ratio look like? The higher it is, then the worse it might be for them to be able to pay in the future. So if anybody has tried to buy a car or buy a house, they're going to be looking at that debt ratio. And they want it to be a certain rate in order to approve a loan. Okay, so do we have any questions so far? We kind of went through that really quick. It's only an hour. No questions? Y'all are so smart. Okay, let's do number 5. Let's look at homework number 5 on Connect. I might have sat too long. I might have to re-sign in. And log back in. Did y'all see the link on Moodle for Connect? Did y'all see it there? Okay, so this is going to be some transactions that we'll have to fill in the accounting equation. So for each transaction, analyze the transaction using the accounting equation. Record the transaction in a journal entry in that proper format. Post using the T accounts to represent the ledger accounts. Use the following partial chart of accounts, account numbers in parentheses, and it just lists out all the accounts for you. And you'll notice they put account numbers as well. So on May 15th, Deshaun Tyler opens a landscaping company called Elegant Lawns by investing $80,000 in cash along with equipment, having a $40,000 value in exchange for common stock. Okay, so remember that everything is with the cost principles, we're going to have a monetary value on everything. So they're telling us how much that equipment is worth. And that's what we're going to use to put it on the books. Okay, so we're getting $80,000 cash and $40,000 of equipment. Assets, they're both assets, right? What's my total asset? 120,000. What's the, if I was doing a journal entry, what would be the other side to that? So I'm debiting in my journal entry, which we'll get there, but if I'm debiting cash and I'm debiting equipment, because those are the two assets I have coming in, total of 120, the offset to that is I'm exchanging it, right? This is what I'm investing in the company, so it's common stock. So in the equity section, we have 120,000. So we have 120 asset, 120 equity. So the equation is in balance. On May 21, Elegant Lawns purchases office supplies on credit for $480. So we're buying office supplies on credit. So are we spending cash? No. So we have supplies coming in. What kind of account is supplies? An asset. It's going to get a debit or a credit? Debit. It's an asset account, so it's going to be a debit. We're increasing asset, which is a debit. Okay, then I'm buying it on credit. So what kind of account is that?
Liability.
It's a liability account called accounts payable. So it's going to have a credit in the liability section for $480. I'm getting supplies, which are an asset. So that's $480. So my accounting equation is still in balance. On May 25th, Elegant Lawns receives $8,800 cash for performing landscape service. So I go out and perform landscaping services. That's my revenue, right? Where does the revenue show up? Where is it going to be in the equation?
Assets.
The sales part, the revenue part. Equity. And the reason why is because it's income. So when you look at the expanded equation from last week, in the equity section, you'll see your income and your expenses in the equity section, along with the dividends and common stock. Okay, so I know that I have 80.
Well, I have a question. If it was on, if it wasn't income, and if it was like on credit, like if it was going to pay them on, if it was going to pay them later on, it would be a liability, right?
If the company is paying, yes, it would be a liability. But this particular transaction, we're actually selling our services. It's telling us that we have cash. So we have an asset, which is cash coming in. So that would be $8,800. However, if we went out and we did the landscape services and we had that customer on credit, we wouldn't get cash right away. It would still be an asset because we're going to collect it in the future. It's future benefit. But what kind of account is it? Do you remember?
Liability.
Not a liability. It's an asset, which is called what?
Credit. I mean, debit.
You're going to debit accounts receivable because you're going to receive the cash in the future. So in this example, we have cash coming in, which is an asset. But let's just say it said that we did these landscape and services on credit. The customer has credit, which means they're going to pay us in the future. We're going to receive that money in the future. So it's accounts receivable. It would still be an asset. So you have an asset of 8,800, and those revenue services that you just performed is sales, right? Sales revenue for the landscaping. So that is an equity. Okay. So we're still in balance. On May 30th, Elegant Lawns receives $2,000 cash in advance for providing landscape services to a customer. Did I do the services yet? I'm getting cash, so I have the asset. So I have assets for the cat. How much was it? 2,000. Asset $2,000. But I haven't performed it yet. I'm liable to do the services in the future, so it's a liability. Okay. So now you see how the equation stays in balance. We have those two things happening on each transaction. Does that make sense? Okay, so let's look at the journal entries. So the first entry obviously has more than 2 accounts that are affected. But we still have things happening on both sides, debit and credit. All right, we're getting cash of 80,000. So we want 80,000 to go in cash. We're also getting equipment that's being put into the business. So that's $40,000.
Yeah, see, ours is just completely blank. And we have to like.
You have to label it.
Yeah.
So it does the proper format. You'll have to select the accounts. And when you get to the liability, I mean, when you get to the credit, it should give you an indentation. I don't know how it does that, how it knows if you get ready to a credit, but maybe it has some formatting on it. Because it looks like it's going to do the proper format. You have to put the date too.
The only date that's in there is May 15th.
Oh, okay. So you may have to put the date in for the other ones. You have to type that in.
Actually, it looks like we just do day 1 and then click on a tab, go to day 2.
Okay. Okay. So number 1 is A. So I'm crediting common stock. So the investment gets traded off for common stock. So we can keep track. So we have 120,000. So I want to make sure that when I have that transaction, I don't just take the 120 and put it in cash. I want to identify with what I received. I didn't receive 120,000 in cash. I received 80,000 in cash. So you want to make sure that you put the right amount in the right accounts. Okay. On May 21, when we bought the supplies, we bought them on credit. So we have a debit to office supplies, 480, and we credit accounts payable, 480.
My numbers are different than your numbers.
Yeah.
Okay.
Yeah, they'll change. It'll be the same problem, but different numbers. But if you miss some of the problem when you go back to redo it, it should let you keep the same numbers. I have it set so you don't have to start over from scratch. All right. Then we have cash that we received for our landscape and services. So we debit in cash, 8,800. Credit landscaping revenue, 8,800, because that's a revenue account. Normal revenue accounts will have a credit. And if I want to increase my sales, then it's going to be a credit. Let's say, you know, if we're decreasing the income, that's an expense. So expenses are debits. So income or revenue is going to be a credit. All right, then I have another service that I'm going to be providing in the future. So I haven't earned it yet, haven't done the work, but I did receive the cash. So I have a debit to cash, 2,000, credit unearned services for landscaping, $2,000. All right, let's look at each account and see what the balance is. So you see we have several transactions that have cash that are affected, right? We had 3. So we're going to look at the T accounts and you'll put those numbers into each account. And so this is what the computer software will do automatically for you when you do those transactions. So maybe I made a deposit, and when I made a deposit in the system, I'm going to banking to make the deposit. So I'm just putting, okay, here's my deposit, today's date, $8,800. I'm saying that's this revenue account because it's for landscaping services, enter. Not really actually putting a journal entry in, you're putting a transaction into the software, but what's the software doing? That journal entry we just did, right? So then the software is keeping track of what's happening to that account. So when you run, remember we talked about the general ledger? You can run the general ledger, you'll see all those transactions. So we don't have a computer software to do that. So we're going to do a T account to see what happened. Okay. All right. So in cash, we had 80,000 that was invested in. So we have 80,000 as cash. I mean, as a debit. And I don't know. Let's see. Right side T account entry must use right side section, left side. T account entries use left side. Okay, so I'm assuming the way they have this set up is the date and amount on this side is your debit and your date and amount on this side is your credit. Yes, we'll see. Yes, that's how it is. Okay, so for the cash, that very first one, we did a journal entry where we debited cash 80,000. Do you remember what we credited for the cash? Was 2 things. So let's look at both first. What else did we have in that transaction? We had 40,000 in equipment. So I should have a T account for equipment. Here's my May 15th, my equipment coming in for 40,000. So now I have 120,000. Do you remember what the credit was? What account? Where's the 120 go? Common stock. And it's on the right side because it is a credit. So May 15th, 120,000. All right, the next transaction when we did purchases of office supplies, $480 on credit. Now we have office supplies. We set that account up. On the left is our debit, $480. Now we should have an offsetting credit. We didn't spend cash yet. It's on credit, so it's accounts payable. So now we have the accounts payable T account. On the right is my credit, $480. May 25th, we received $8,800 cash for the services that we performed. So here's the cash, $2,000. Nope, sorry, $8,800 cash we received for the services performed. So now I should have a revenue account. And here it is, landscape and revenue, credit 8,800. We received $2,000 for services that we're going to provide in the future. So here's my cash, May 30th, 2,000, and I should have an account, unearned landscape revenue, credit 2,000. Question?
Yeah, so whenever you have the debit account, you have the credit account.
Yes. Your debit and your credit should match. Yep. So that's all this problem wants to do, but we're gonna do an example next that is going to be, let's say we did all of this already. We had the transactions. We've identified what accounts they go in through the journal entries. We bring them into the T accounts, which is what we just did here. So now what is my ending balance in cash? 90,800, right? So I'm gonna go set up my trial balance. So this trial balance, let's see if I can split the screen. I don't know if it'll do it. Let's see. Gotta move this out the way. Okay, so let's just do a trial balance real quick. So we have cash, 90,800. We have office supplies, ending balance $480. Equipment, 40,000. Accounts payable. So all I'm doing is just taking each account that we used. I'm listing it out with the balance. I don't think it's going to show it to you as a credit. I'm just going to leave it as a debit, as a positive number. It's not really a debit, but I think that when they give you the numbers on the examples, they're going to be positives. You'll have to know if it's sitting as a credit or a debit. Okay, so we're going to list it that way. All right, then we have unearned landscaping for 2,000. Common stock, 120. And then we should have revenue. I mean, that's basically it. So this is what the trial balance would look like for the transactions that we just did. And I don't have it in like a format for a report, but that's, you get the idea. If you have to do a trial balance, this is what you're doing. Going through each account that you used in your transactions, and you're just listing them and pulling the balance in each one of those accounts. Okay, so this is where we're going to start from on the next example. So we're going to say all that other stuff happened. Now we're going to pick up with a trial balance, and we're going to walk through putting the financial statements together.
There's a question.
Okay.
So I noticed you don't have the B, elegant launch purchases, office supplies on credit for 380. You don't have that listed under cash. You have that listed under, okay, accounts payable.
Yes, because we did not pay for it yet.
And then it's on the right side because.
It's a credit.
Okay.
Because it's a liability. You'll be liable to pay that in the future. So it's increasing liabilities, which is a credit. If you're paying that liability, then you're decreasing liabilities, it would be a debit. Okay. So let's walk through this problem. Okay, I tried to set it up similar to how it is in the homework. Now I have the titles in there, but like I said, I think you have to put the titles in there. So here's my trial balance. It has the list of accounts and the balances in those accounts. I want to take all of that and bring it over into my statement. So what's the first statement we're going to start with? Remember? Income statement. So we're looking for income accounts first, and then we'll be looking for expense accounts. Okay, so we have consulting revenue, and I'm just gonna highlight them off as I go. You can scratch them out. This might help you when you're preparing a financial statement. So we have consulting revenue. Consulting revenue. 21.5. Okay, do we have any other revenue? Rental revenue. $2,400. Okay, that's it for my revenue accounts. I have unearned revenue. Don't get confused. We haven't done that yet. So we can't say that we made money on that yet because we haven't done it yet. You have to wait. Okay, so let's look for expenses. We have salary expense. $4,900. We have utility expense. Advertising expense. $780. Rent expense. Okay, so now I have all my income and all my expenses. So it's going to total, you're going to have to put your total revenues. I had the formula in there. I don't know if it does that for you on the homework. I'm not sure if you have to add it or if it does it automatically. You'll probably have to put the title in, total expense and total revenue. Then we have a net income of $13,740. Now we're going to use that. Remember, we're going to have to add that into our retained earnings. Okay, so let's look on our list and see if we have retained earnings to see if we have a beginning balance. If it's not listed, then it's going to be 0. Okay, so we don't have a beginning balance. So retained earnings, now what am I adding? Do you remember from the example we looked at? I'm adding, what did we just figure out? Net income. So we're going to add net income. Maybe I wasn't supposed to put it in there. I think it's supposed to. There we go. Okay. And then I need to take out my dividends. Yeah. So less dividends. So I should subtract out my dividends. So we got to go get that from the list. Okay. So we brought in how much in revenue? $23,900. Did we make $23,900? No. Why? We had expenses. So we had to deduct those expenses from the income. What else did we do? We paid some of that money out in dividends. So now we have to reduce it even more. So in the end, we have an ending balance of $98.40. So for this year, the company is going to keep $9,840 that it made, and it's going to roll into retained earnings next year, which is going to be beginning balance for retained earnings. Okay. All right. So let's look at the balance sheet. So we're going to list all of our assets out first. I know equipment's on here first, but I like to start with cash. Whenever you have your formatting for your balance sheet, you want to do the one that can be liquidated the easiest first. And that's typically the order that they'll go in. So cash is usually always first, cash and cash equivalents. Okay, so we have cash of, guess I need to, let me see if I can hold this. I don't have it. It's this one. Okay. Cash is 11,800. Okay, what else? We have equipment, that's an asset. We have accounts receivable, that's an asset. Office supplies, notes receivable. So let's do accounts receivable next. Those are easily converted to cash. And we'll look at this later in the semester, but accounts receivable, sometimes businesses will sell their accounts receivable and somebody will buy them and you'll have to pay a small fee, but you get your cash quick. So depending on the situation you're in, some people will do that. Sometimes they sell the old receivables, so they don't have to worry about trying to collect from people that don't pay. They let that headache go to somebody else and they'll just lose a percentage of that money, but it helps your cash flow. So they can be easily converted to cash. So we have our accounts receivable. All right, let's do office supplies. Let's do the equipment. Prepaid insurance. So I don't know if we talked anything about this last week, but it's an asset. So if I buy insurance and that insurance is good for 12 months, it's going to be benefiting me in the future. If I buy it today and it's good for 12 months, I should not expense it now. Remember I was talking about the matching principle last week where we want to try to have our revenues match our expenses. So if I buy the policy and it's benefiting me for 12 months, we want to take the policy for the year and divide it by 12. And so each month we'll have an expense, be the same amount the whole year. Okay. So for now, it's going to sit as an asset and I will reduce that asset as we go through the months. So 1 month will go into expense and reduce it. Next month it goes into expense, we reduce it. Okay, let's say it's $12,000 for the year. So each month, $1,000 will be reducing that prepaid. And it will also have an expense each month for $1,000 for insurance. Okay, so then we're recognizing the expense when we're receiving that benefit, when we're being covered for whatever business we're doing at that time. So this is an asset. Okay, we have a notes receivable. That means similar to an accounts payable where somebody's paying us for something, but maybe it was a large purchase and they couldn't pay it in 30 days because a lot of times accounts receivable you have to pay in 30 to 45 days. So let's say they have a large purchase. Let's say you Ashley Furniture. Ashley Furniture does this all the time. They'll say, okay, you can buy it now and you can pay over the next 12 months, 0 interest. So at that point, they now have someone that's going to be making a payment every month. They don't have someone that's paying it off in 30 days, right? So they'll have a notes receivable. So all the clients that come in that do that, they have a notes receivable account set up for each one of those clients. So now they know for a set amount each month, this is what I'm getting in. That's what a notes receivable is. A little bit different than accounts receivable. Okay, so I think we have everything for assets. We will know if we don't. Why? Because it's not gonna what at the end? It won't balance. Okay, so let's look at liabilities. So we have a notes payable and we have accounts payable. I'm gonna list accounts payable first because accounts payable usually is due within 30 days. So we want to put that one first. The notes payable is probably something larger that we bought that we're paying. Maybe we bought furniture on credit for the business and now we're going to be paying $1,000 a month. So we would set that up as a liability and then we would reduce it, right, as we go and as we pay. So let's do accounts payable first. Where is it at? Here it is. And do notes payable. So we have 4,300 for that and 7,380. What was it? 4,800? 4,300. Okay. $73. Did I put 7,380? Okay. All right. So then we have common stock. Oh, we have unearned revenue. Sorry. Missed that one at the bottom. And we have common stock left, and that goes in our equity section. So we have 19,200 and 680. Okay, I'm out of balance. So I either have a number wrong or we missed something or something's in the wrong place. I wonder if I can- All right, so let's go through it again real quick. Let's go back through the revenue and expense, make sure we have the right amounts. So we have revenue, 21,500. Rental, 2,400. Salaries expense, 4,900. Utility expense, 580. Advertising, 780. Rent, 3,900. Okay, I'm just checking the accounts, make sure we didn't miss anything. I think we're good. Okay, so then we have net income. That's right, 13,700. Dividends, 3,900. Cash, 11,800. Accounts receivable, 5,400. Do y'all see it yet? Office supplies, 3,400. Equipment, 13,500. Prepaid insurance, 2,900. Notes receivable, 4,400. I do have the answer on the next tab, just in case we had an issue. Okay, so accounts payable was 7,380. We had notes payable of 4,300. Unearned revenue was 680. That's right. Common stock was 19,200. Okay, it looks like everything's right, so I'm not sure. Let me, let's look here. Oh, I didn't do my total equity and my total liabilities. Did I not have those on there?
Retained earnings, what was missing?
It's the total, I think. Retained earnings. Forgot to add this in. There we go. Forgot to bring this over. Sorry, guys. All right, so it was a good example of what to do if it doesn't balance, right? So we know that it should, the balance sheet should balance assets equal liabilities plus owner's equity. So that's the process of going from a trial balance into the statements. Do y'all have any questions about it? So there's the homework problem that does walk through this process. It might be the last one. Number 12, I think, is the problem. Okay, so here's an example that we just went through. Okay, it's going to give you your trial balance. It's just a list of accounts with the account amounts, balances that are in there. First thing is your income statement. So you'll just gather all the accounts just like we just did. You'll put your titles in, list your accounts. You have to put your totals in. Then you'll go to your statement of retained earnings. So you're going to start with 0 because they don't have retained earnings on here. Okay, then we have to add our income, deduct the dividends, and we have our retained earnings ending balance. Don't forget to pull it in like I just did. So when we go to the balance sheet, now we're listing out our assets, liabilities, and equity. So you'll go through the same process that I just went through. And you'll put everything in, come up with your balances that are listed there, and you should equal in the end, assets equal liabilities plus equity. So you'll have a problem to do exactly that. See what this one is. I think this is okay. So this problem is going to give you the transactions, and you'll have to do journal entries for the transactions, and you'll have to do the T account for the transactions as well. So we did an example with the T accounts and the journal entries. This one is just another homework problem just like that. Some of them will be easy, just identifying what type of account it is. This is to try to get you used to seeing the accounts that you're going to be using. What type of account is it? So this is looking for if it's a revenue, equity, liability, expense, asset. So you're just identifying again. So some of them will be easy, some of them a little bit more difficult because you'll have to know the titles and be able to put the numbers where they belong. So any questions? It's only 7:30. Went through that quick. Are y'all good? Any questions on Zoom?
No, all good.
Okay. Will the homework
I have,
side?
I have a question. I went to Chuck over the weekend, and but I want to ask you if we can do like a Zoom meeting if I don't have to, pay Chuck for his time,
If we can do a Zoom meeting for what?
for like tutoring or homework during like your office hours.
I don't have office hours. If you get stuck, just email me
Okay.
and we'll try to work something out.
All right.
I work during the day, so it'll probably be evening or weekend.
Okay.
Sometimes I do, like a study session if I need to before the exam. I do have tutoring on the Moodle at the top. Chuck is really good.
Yeah,
So,
I met him.
yeah.
He's real nice. He's real nice.
Oh, did you talk to him?
Yeah, I met him over Saturday or at a coffee shop by his house.
Okay, good. He's in Metairie, right, by Lafayette Park?
Kenny, yeah.
Okay. Okay. Thank y'all.
All right, nice session.
Thank
Okay.
you.
All right, thank you.
Let's try this. Yes.